How you doing, Adam?
Oh, having a day,
Having a day.
just like the market.
It's a bloodbath out there.
That's all right. It happens sometimes.
It does. It does. Did you see so the Olympic swimmers, right? They're breaking less records. They're blaming the pool being too shallow.
Yeah, I did see that actually. The pool is only 2.2 meters deep. It's a temporary pool,
Right.
so they could fit more people in the arena to
Right.
watch. And I guess it's causing more turbulence. They also have added many more underwater cameras.
Right. That's messing with it. It's
Yeah.
interesting. Very interesting. Because usually
This-
you have a couple records broken each year. I think there's only been one record swim.
I think they anticipate the number. It has been, 5 to 7, call it most Olympics, but they anticipate that to decline over time as the margins for success and errors get smaller.
Right.
But the swimmers are noting that it's a slower pool. Yeah, I heard anecdotally they even after they wait, 7, 8 minutes before each heat or each race and each event, they can still see the water moving. It's not
Right.
still before the next race goes off. So that's a testament to the fact that there's,
What's slowing them down?
yeah, I don't know. Is there more volatility in the market today or in the pool? It's 12:01. Should we get started?
Let's do it. So welcome to any new viewers and welcome back to those who have joined us before. We are actually breaking records in attendance today, which is great. And also our inbox has been flooded with questions and comments coming into this webinar, and we love it. So keep them coming. There is a question box on your screen that you could submit questions. We do have a lot that came in and we built them into the presentation. So I can't say we can get to everything, but we will certainly do our best to try. I am joined here with Adam Armstrong, who is a CFP and wealth advisor at the firm. My name is Austin Hageman. I am a CFA. I hold the CFP and AWMA and also a wealth advisor at the firm. Just quickly about Withum, since we do have some people, some listeners who are not clients. Withum Wealth is a registered investment advisor providing unbiased investment counsel and wealth advisory to wealthy individuals, foundations, and institutions. And there are a lot of benefits to working with an advisor who is independent, a true fiduciary 100% of the time, and that has the institutional reach that we have. The vast majority of advisors, the large commercialized names, they can't say they have all three. So, if you're interested, we'd love to talk to you about the benefits. Go to our website, reach out, say that you saw us on the podcast. We'd love to hear from you. How is that? Can we jump in?
Let's dive in. We got a lot to cover today.
All right. Let's bring back up old big bad inflation. We had a negative print, right?
Yeah, so this is probably the biggest development over the last May and June uh, inflation reports, which came out in June and July. Um, this is what the Fed has been trying to accomplish by hiking rates 525 basis points. And it looks like in Q1, we had the scare that inflation was coming back and the rate hikes were maybe not enough. That was clearly not the case. It was a temporary blip, higher reports. Um, and I would just note that a negative month or prices dropping month over month is not ideal. You don't want to see that. You do want some level of inflation to ensure that there's still demand. But one negative month is not the end of the world, right? We
Right.
need
It's
to
not
make sure we're
unusual.
not seeing repeated negative months and arriving at a annual inflation number that, is negative or nil, so to speak. That would signal no or weak demand, which would be bad.
Right. Right. But this is what the Fed wants to see to an extent, right? They want to see inflation coming down. They didn't lower rates the meeting the other day. Potentially maybe September. I guess we'll get to that a little later on.
Yeah, we'll get into that for sure. But I think what they talked about yesterday was that a cut is imminent. It seems like they're getting confirmation that inflation is coming down. It should continue on that trend. So I don't know what they waited for. Today's jobs report and yesterday's, um, the unemployment claims came out higher than expected and lower than expected for the unemployment rate. So, there's definitely cracks in the economy starting to show up more and more.
Yeah, and the Fed's definitely more worried about moving too soon than they are about moving too late. Because if inflation does get away from us, that could be, not a great environment.
That's a good point. I mean, honestly, their job is maximum employment and low prices, stable prices, right? So I, you know, you can debate whether you can accomplish both of those things in perpetuity, but I fear that um, they would not like inflation to rear its ugly head again more than they would tolerate a recession or a contraction in economic growth.
Right.
Um, I think what's interesting if we dive into the actual components of inflation, though, all through 23, as you can see on this chart that we're looking at here, the green lines below the zero bandwidth, that was energy prices helping in early 23 to contribute to lower inflation numbers. Energy has stabilized to some extent. And now what we're seeing is we're actually seeing core goods, so commodities, X, food and energy, actually starting to contract as well. So it's not just energy from a headline number that's causing inflation to come down. It's other aspects of the economy as well, which I think is positive.
Right. And shelter's actually starting to come down a bit as well. We're seeing a nice little trend here.
Yeah, it's contributing less to inflation, right? Rent and housing prices or owner's equivalent rent is the biggest portion of the CPI data point. I think somewhere around 40%. So the fact that is it's growing still, but just not nearly as much, right? That alone now is below 2%. It was itself above 2% contributor to inflation. So that is positive to see. Yeah.
Right. Right. So it appears that inflation is moving in the right direction. You mentioned the Fed's dual mandate, inflation, and unemployment. Let's jump into some of the unemployment trends we've been looking at.
Yeah. So this is something that we've now been tracking for, call it 6 months. We heard about the idea. A colleague and I heard about this idea last September and then started tracking it. But what we're looking at here is the blue line that you're seeing on your screen is the unemployment rate over, since the 50s. The dotted black line is a moving average over the last 3 years. So what has the average unemployment rate been over the last several years? And what we noticed was that when the current unemployment rate moves above that 3-year average, so where has the employment rate been over the last 3 years? Are we above or below that? Every time we cross that, 11 out of 11 times since the 50s, a recession has occurred within 7 months. More often than not, though, it's pretty imminent, either at the beginning of the recession or within several months, like 1, 2 months. So from an economic perspective, this is concerning to see. I believe that 3-year moving average currently sits at 3.9 or 4%. And after today's report, we're at 4.3% unemployment. It was previously at 4.1. So this did cross that moving average last month, actually. But it's commonly also seen as, or a similar metric is the SOM rule, which if anyone's been watching CNBC today, they've probably said that 50 to 100 times already. But this is an interesting trend.
Yeah. And for anybody out there sitting back saying, what the finance, I don't understand this. Basically, all we're saying is we're tracking the momentum of the amount of individuals becoming unemployed. So when the trend in unemployment picks up to a certain extent, what we're noticing in the data is that it usually indicates that we're either in a recession already, we'll see one soon, or we just saw one. It doesn't mean that we haven't seen one yet or that we're in one, or it could mean any one of the three within a high probability.
Yeah, I think it's very important to note that we just also had the second quarter GDP report come out that showed the economy growing at a 2.8% annual rate. That was faster than the first quarter, which was just 1.3% annualized growth. So I think that is, I don't think you can have a recession without negative growth. So that's important. And it's also worth noting that the National Bureau of Economic Research, the NBER, they only determine the start date of a recession long after the fact, right? So we could, let's say the recession does start today, hypothetically, it might not be until next summer when they actually say we're officially in a recession and it started last year.
Right. Right. Now, recession is a bit of a dirty word. I think it causes an emotional reaction in us. But we looked at the data, right? And when we see this cross, it doesn't actually necessarily mean something bad's going to happen with stocks, right?
That's right. And, we can put some context around this too, but these green boxes that are pinpointed on each of the instances where the unemployment momentum picks up above its recent average, it highlights the 6-month, 12-month, and 18-month forward returns of the S&P 500 on a total return basis. So there's volatility in the short run. The 6-month look ahead, there's some negative numbers in here. There's some greatly positive numbers in here. On average, since the 50s, anytime we've had one of these indicators fire, you see an average 6-month forward return of 4%, which is pretty much smack dab on the long-term averages for the market, right? What's interesting is once you look out further, 12 months and 18 months into the future, you start to get above average returns. So on average, looking out 12 months from when this indicator fires, you have nearly a 16% return. So that's well above long-term averages. And then 18 months, 22.5% total return basis, still above long-term averages. So I think this is really important to note that let's say we are in a recession, stocks are meant to forecast that and anticipate that, right? So the fact that I think we are at all-time highs in the market or pretty close to it, right? I guess maybe now we're in a 6-7% drawdown off those highs, but 2 weeks ago we were at all-time highs. That should be telling you something as well, because unemployment numbers, what we're looking at, the market should be processing this information, right? It processes everything. Markets are efficient. And so whatever we're thinking about, talking about, worried about, if it's data rather than, say, theory, the market should be anticipating this.
Right, right. Dating back since 1948, 80% of the time, this has actually been something for investors to look forward to when these two lines cross, based on this information, right?
There were 2 instances where long-term forward returns were negative 18 months out after this indicator firing. And that was, 2000, 2001 recession and 2008. And I think if you look towards those recessions, they were particularly bad. You had the bursting of the tech bubble, which caused a recession. And then we had September 11th, which exacerbated the already weak economy, right? So shutting down global travel and, businesses in the country and around the world. And then also in 2008, we obviously had the great financial crisis, which was much more systemic and widespread in that regard. So it was one of the, if not the deepest and longest recession since the Great Depression. So I think if you take out those extreme recessions that we had, looking out 18 months, most of us, if you're invested in stocks anyways, you should have at least a 12 to 18-month time horizon, if not much longer than that. This has represented actually a good return historically on a forward-looking basis.
Right. And like it or not, this is generally a part of the process of bringing inflation down, right? To bring inflation to the Fed's target. If there's less people working, there's less people spending money, there's less money flowing around. That in and of itself brings inflation down.
There were net new jobs created this in the month of July with this morning's report, net new jobs of 114,000, right? I believe last month was 150 plus thousand jobs as well. We haven't seen any contractions on the net in the people employed. So the unemployment rate is going up because the labor force, the amount of people looking for jobs and looking for work is increasing faster than what new jobs are being created. But it's definitely something worth watching into the future.
Right. So we have inflation coming down, we have the unemployment rate rising faster than the average trend. What do we think about the Fed? Do we think they're going to cut in September?
Yeah, I think now the question is, why didn't they cut, right? They clearly did not have an inside track to what today's job number would be. And I think if they had seen it a day earlier or 2 days earlier, maybe they would have, maybe they're kind of, pounding the table, wishing they had cut at this point. But, this data, even on this chart now after the last 2 days, is stale. But the last dot plot, and for a reminder to those who haven't watched recently or don't know what we're looking at on the screen, the dot plot is simply a mapping of where each individual Fed member, represented by these dots on the screen, projects interest rates at the end of the following year. So 2024, 25, 26, and over the quote unquote longer run. So each black dot there represents one Fed board member and where they expect rates to be. The last time this snapshot was taken at the June meeting, they projected 2 interest rate cuts before the end of the year. The market, when we took this snapshot at the end of the quarter, was projecting 4.6%, which would be somewhere between 3 and 4 rate cuts by the end of the year. So the Fed, I mean, we'll have to see how much they want to stick to their guns here and be assured that inflation is heading down towards the 2% target before they do start cutting. And I think what's also going to be interesting to watch over the next several weeks, their Jackson Hole event is coming up. There's always some sort of, important guideline that comes out of that meeting that we need to be aware of and look towards. But I think now the concern is going to be the pace at which they cut rates and the cadence at which they cut rates, right? On the way up, it was at first a cut, and then they started doing 50 basis point high. I'm sorry, at first a hike, one hike, then they started doing 50, which is 2-point hikes. So, the cadence at which they cut, will they do 2 cuts or 1 cut in September? Will they stick to 1 cut per meeting? Will they skip meetings? Those are going to be a lot of questions that the market is going to be searching for answers.
Right. I think as of right now, we could say with a pretty high confidence that we're likely going to see rate cuts in the next 6 months. And I think for investors, it's important to start thinking about, well, what does this mean for me and my portfolio? We've also seen support from the performance of these of the underlying investments, right? We've seen this great rotation as of late, which has unraveled a little bit in the first 2 days of August so far. But essentially, we've seen small caps really jet up in price, right? Small caps are up. Russell 2000 is up 9.4%. The S&P 500 since a report of inflation softening on 7/10 to the end of July, the S&P 500 down 3.4%, Nasdaq down 9%. I mean, this is a huge shift in that the Russell 2000 U.S. small cap stocks are outperformed the S&P 500 by 13% and the Nasdaq by 20% from that 7/10 inflation reading to the end of the end
in
of
under a
end of
month. Yeah, that's a wild difference. And we've talked about this before, that S&P 500 companies 80 to 85% of those companies' debt is fixed at longer term rates, where the rate hikes did not affect them as much. Whereas then you look at
In
small
some
cap
ways,
company.
it almost helped them too, in certain instances, right? With those companies holding a lot of cash, because all of a sudden they started collecting 5% rate, 5% yield on cash they're holding, the large cap
Yes,
companies.
right. I think I saw Google earned $1 billion on their cash just in the last quarter, according to their earnings, which was more revenue than Starbucks had revenue, right? The
Right. It's a big
interest
deal.
that it's absurd. Yeah. Um, so yes, I think lowering rates, it will help these small companies who, 60 to 65% of companies in the Russell 2000 small cap index have floating rate debt, right? So these rate cuts are really going to help those companies. And what you saw in the July inflation report on 710 was a clear softening. Um, there were expectations for more rate cuts being baked into the market. And then you saw small cap companies start to really outperform. Um, Now, today, we've seen everything down, right? And I think today's messaging is more about a weak economy than any sort of inflation expectations being baked in here. And I also just wanted to share, a couple days ago, there was an 85% probability of one rate cut in the September meeting. And as of this morning, there's actually now a 68% chance that there will be two rate cuts at the September meeting. So when I hear that, um, first, I think there's probably some middle ground in there, right? Markets tend to react and then take a lot of time to digest afterwards and moderate to some degree. Um, so I think whether they go once in September or twice in September is probably up in the air at this point. We will have another August jobs report before their meeting and another inflation report, I believe. So those are definitely going to be worth watching and stay tuned for more, I would say. There was also about a 60% chance a few days ago of having three hikes before the end of the year. And now there's just a 13.8% chance we get three hikes. I'm sorry, three cuts by the end of the year. Now it's a 42.2% chance of four cuts, 36.6% chance of five cuts before the end of the year. So today's report was definitely a doozy. If you are a bond bull, then that is probably good for you. And some of the things we've been saying over the past couple of quarters have been playing out, and we're finally getting that volatility.
Right. We've talked a lot about extending duration based on your goals, right? If you have cash on the sideline, that is for intermediate long-term goals. Now's the time to be thinking about putting that cash to work in longer duration bonds so you can lock in the yield curve at this higher inflated rate because the Fed has raised rates to where they are today, right? You may accept a slightly lower yield than if you went out, if you're holding a money market versus going out 5 years. But guess what? When the Fed does eventually lower rates, your money market yield is going to go down in pretty much lockstep. While as if you went out and bought a 5 or 6 year bond, right, yielding 4.5, 5%, then you're going to be able to collect that all the way up until it matures. So
That's
you're going
right.
to be able to hold on to that higher yield for longer, right? Now there's a lot of crosswinds, right? So we don't expect this to be perfect. For example, small cap, it can be looked at as a leveraged bet on rates coming down. However, rates coming down is while it is a good tailwind for small cap stocks, there's a lot of other things that could interfere with that, right? So we're not saying, rush into small cap stocks or rush into, 30-year US treasuries. But what we are saying is to be cognizant of, how much do I have allocated to small, mid, and large? How is my diversification? Am I over allocated to those top 10 names in the S&P 500?
Right.
Those are things that our advisors, our analysts, our portfolio managers are thinking about. And to those people who are investing on their own, things that you should be thinking about, not necessarily jumping ship from one asset class to another or from one investment style to another, but where is your diversification?
Staying diligent. Yeah.
Right, right,
Um, you know, I think the rate cut the interest rate forecast and what the Fed will do is not just something that the markets are concerned with and investors, but CEOs as well, which I think is interesting. Um, you see in earnings calls, people are talking about anticipated rate cuts as a reason for why they think business will pick up in the future as well. I think is interesting. Like on the Whirlpool earnings call, they talked about how their incoming call volume and inquiries for washing machines, refrigerators, dishwashers, dryers, etc., was at record highs, but their sales were not following through on that. And a lot of those calls were saying, okay, I like this, but I'm waiting for rates to come down before I do this renovation or finance it or go buy a new house. And then I'm going to need all new equipment, right? They're getting prices quoted out, but they're not actually purchasing yet because people are waiting for rates to fall. And for Whirlpool, they said they're not actually laying off employees when they might otherwise do so because they anticipate this demand picking up once rates come down. So I think the higher unemployment rate is one thing. The rate cuts for slowing economic growth, the Fed is still walking on a knife's edge here of trying to thread this needle of not cutting too much too soon and seeing a reacceleration of the economy. And you can hear it in these company earnings calls that there's real big businesses out there that do anticipate things picking up as soon as rates are cut.
Right.
Rates coming down is going to be great for cyclical companies, or I shouldn't say it is going to be. It might be good for cyclical companies, banks, auto companies, housing market, right? There's certain areas of the economy that can do very well in a falling rate environment. And, the question is whether the economy is still strong enough, people can still keep up consumer spending well enough to withstand the time it's going to take for rates to come down.
Right. And you mentioned the housing market. I think that's pretty topical for a lot of our clients, a lot of listeners, in that you're either waiting to sell your house until you can get buyers because rates come down, or you're waiting to buy a house, right? When rates come down, there is a legit theory, a legit thought that housing prices are going to go up. So for those
Right.
people waiting to buy a house for rates to come down, there is a chance that you might be better off just buying now, locking in a higher interest rate, and then refinancing when rates come down, right? Because when
Yeah.
rates come down, it is very possible that the price of the house that you wanted to buy but waited on is going to go up, right? And it's going to offset any benefit from rates coming down. Who
Yeah.
knows what's going to happen, but very possible.
It absolutely is. Point being, there could be a tailwind of economic activity from more houses being transacted in the future if it's for the right reasons.
Right. Now rates coming down around this time, hopefully, maybe September, hopefully in the next 6 months, that really fits in with something we talked about in a podcast via our Amplified Wealth channel, right? I think last September, about the lag effect.
Yeah, this is something that you know we've talked about this before, but the Fed hiked rates over the course of a year and a half, 2 years. They got up to this point. Their last rate hike was last July, so July of 2023. Now, this is showing that recessions typically occur on average since the 80s, 11 months after the last rate hike.
And the
So,
recessions are the gray bars, right? The last Fed rate hike is the black bar, right?
yep,
Just
and
for
those
those
black
following
bars
along.
are
Yep.
counting the months until the recession officially starts. So we are a year since the last rate hike. I think what's interesting is in almost every one of these scenarios, you see rate cuts before you actually get to the recession. So look, again, I don't want to say this time is different and we're not going to have a recession. We very well might, but it's interesting to look and see that the timing of all this is coinciding with some disappointing jobs numbers. Also, I mean, kind of blanked there on what I was going to say next. But
Well, you mentioned this time, potentially being different.
right.
Yeah, there's like on the other hand type conversation you'd be having yourself, in that there are different elements leading up to this. In that we did have the global pandemic, we did have a lot of money flood into the economy. We did have the Fed raise rates. I don't know that they've ever raised rates this quickly. The fact that they're being so transparent with, when they're going to raise rates or lower rates, or at least more transparent than they usually are, there's a lot of differences there. And, the way that we're seeing the data come in, it's possible that we may see a soft landing, right? We may not see a recession. However, on the other hand, right, there is plenty of news articles out there that it shows that as soon as the news articles start streaming in about, oh, we did it, we have the soft landing, the Fed did it, um, a month or so after, we hit a recession, right? So we've been in this place before talking about this. So who knows? But things are different leading up to it. That we definitely know.
Yeah, this is exemplifying the lag effect, right? The Fed stops hiking and then it takes a year for this to flow through, sometimes shorter, sometimes longer to flow through to the economy. And we're starting to see that stress now, but that's what the Fed was trying to achieve. They were trying to get demand into a weaker place. And now they're going to be cutting rates. Everyone has known they're going to be cutting rates, right? So the anticipations, you can see it in the consumer sentiment reports, forward inflation expectations by consumers, not economists, consumers, has come down dramatically to a much more reasonable and long-term place. So, again, the Fed is walking this very fine line, and hopefully they can accomplish it. But it is quite interesting to see this. And we would also expect this lag. You have to expect if there's a lag effect on the way up when the Fed is hiking rates, you also have to expect that there will be some lag when they start cutting the rates as well, right?
Right.
I don't think you can just cut rates overnight and immediately see that flow through. Again, maybe it's possible, but mortgages are based more so off of the 10-year interest rate, which does price in anticipated cuts pretty immediately. Shorter term debt, credit card interest, things like auto loans are much more tied to shorter term interest rates. So that's where once you start to get cuts, you could see more demand pick up in those areas. Or maybe people start going back to variable loans to buy their houses. Those are things to sort of watch for what could be more immediately stimulative to economic growth as soon as the Fed cuts rates.
Right. And I just want to highlight, you mentioned stock market expectations, right? I think that's very important, especially this time around. Historically, right, if we go back 30 years, when the Fed lowered or increased rates, you would find out the next day that they did it, right? There wouldn't
Yeah.
really be much of a lead up. More recently, the Fed has gone through the process of having these meetings, being more transparent with what they're looking at, things like that, which is giving the stock market more information. It gives the stock market more time to price things in. So, hopefully that helps. I think it has helped to date. I know there are people that say, oh, the Fed dropped the ball, the Fed did this, Fed did that. They're doing the best they can. And I think they definitely improved things by being more transparent.
Yeah, I gotta say, and I've I think on the podcast we did with Mike Townsend, which everyone should listen to that. Last week, I was talking about if the Fed knows they're going to cut rates in September, why not just do it already because of this lag effect, right? So it'll be interesting to watch this play out, and hopefully they can cut enough, quick enough, if there is real weakness to be coming in the markets, in the economy, I should say. Hopefully they can get out ahead of that and just, avoid a recession or a big economic contraction. The last thing I want to say on this topic before we jump forward is, and maybe this is a good segue to the next slide, we have to remember that we went through a bear market in 2022.
Right.
At that time, there were legitimate fears that inflation was way too high. It was up at 7, 8, 9%, and the Fed was going to have to hike rates high enough to have a recession. Now, I think it's really important to remember that the stock market is always forward looking, right? The stock market is trying to price in all known information today and essentially what people expect on average for the next, call it 6, 12, 18 months into the future of earnings and projecting out what companies will do. And to me, the fact that the market has been so strong over this last year, maybe aside from the last 2 weeks, is a testament to the continued economic growth and reacceleration of growth that we've seen in the last year, compared to 2023 or even 2022, right? So it's very possible and not unprecedented that the market sold off in 2022 in anticipation of whatever economic weakness could be coming, if any at all.
The market already went through the pain that the economy might be going through soon.
Yeah, and typically it happens, like I said, that 6 to 12 to 18 month time frame. I think if you poll most market forecasters, I think most people, ourselves included, would be surprised at how resilient the economy has been in the face of 5.5% rates, right? So I think it's completely fair and within a reasonable enough time frame that we saw the bear market preceding what might be an economic slowdown.
Right.
And the
Which isn't
slide,
unusual.
no, it's not. Walk us through the slide.
Yeah, so we've shown this in prior webinars, but what we're looking at on the left-hand side, these are different recessions. The dotted blue line is the S&P 500, the stock market in each of these, right? And then there's earnings as the red line, there's GDP as the gold line, and payroll. So what you see is the stock market historically has bottomed before we see these different data points that are, signs of the where the economy is bottom, right?
Yeah.
So the stock market bottoms and then the economy bottoms, stock market bottoms, then the economy bottoms. So, what we're saying is that, support of what Adam was saying is the market is forward looking, right? The market tends to feel the pain before the economy actually gets there. And what you find is a recession, finding that we are in a recession or being in a recession, even if you don't know it yet, because like we said, the government looks back and then says, oh yeah, 3 months ago, that was a recession, is actually a good sign for investors. It typically means that, we have already bottomed.
Yeah, there's a lot of other things going on too. I mean, we haven't even talked about the election.
Yeah.
Right. So markets hate uncertainty. And I think what the last couple of days have brought is just a cloudier picture of what might happen, right? If it was more predictable what the Fed was going to do, I think people could go on with their day a lot easier and start planning for the future a lot better.
Right.
So whenever you have more uncertainty, it creates dislocations in price. It also creates opportunities, right? But in a lot of these charts, the stock market sometimes, as with the COVID example on the bottom right, the market bottomed a month before payrolls bottomed, right? And earnings didn't bottom until late 2020. But in other examples, there are, a year, 2 or 3 in certain cases, similar to maybe like what we're living out today, where the market bottomed in 2022 and maybe we have more economic weakness ahead.
Right. So yeah,
no, go ahead.
All right. So I was gonna jump to the election unless you had something more you want to say about this.
No, I mean, even just in the last week, the likelihood that we're going to have a really close and contentious election is really increasing, right? If you think back to Biden's debate, immediately after that, it seemed, I think Trump got up to 66 or 68% in the betting markets, offshore betting markets, likelihood of winning the election. And the markets like that, not from the perspective that they want Trump or anything like that, but more just that they know that who the president will be, right? The uncertainty has gone away. And now if you have a toss-up between Harris and Trump for this election, if it's really 50-50, that's not a good environment for the market, right? The market wants some certainty and they want to know, regardless of the actual outcome.
Right. Now, we've had a lot of questions come in today, come in leading up to this about should I overweight gold, small caps, solar, crypto, because so and so is this percent, in the polls, right? And also you do see, I won't, you can't ignore that you do see different sectors and different parts of the market shift based on, the polls and based on expectations about the
Right.
election. However, I hate to burst everyone's bubble, but just it's hard enough to guess who's going to win the election. It's even harder to know what investments are going to do well in association with whoever wins the election. For example, energy stocks would seem like a great investment under Trump, right? Um, what's his new slogan again?
Drill, baby,
Uh,
drill, I
drill,
think is
baby,
what he's
drill.
been saying. Yeah.
Very, very much in support of oil companies, not in support or not as much in support of green energy companies, right? Guess what? When Trump was president, energy was one of the worst performing sectors, right? And green energy stocks performed very, very well under Trump. Now, Biden is the opposite, right? He tends to be more pro green energy stocks, less support of oil companies. Well, guess what? Over Trump's administration, energy stocks have done very well. Green energy stocks have not. Now, a
Biden.
lot of that sorry, Biden, yeah, under Biden. Green energy stocks have not done well, which you would have thought that they would have. And then energy companies have done very well. Now, a lot of that had to do with interest rates, right? And other factors other than the election, right? A lot of green energy companies tend to be smaller cap, right? They tend to have more floating rate debt, et cetera. So rising rates is not a good environment for them. But it just points out that there are so many things going on, so many bigger things going on in the markets to impact the markets and the economy to impact the markets that, trying to make a gamble, trying to push all your eggs in one basket based on who you think is going to win really puts you at a point of exposure that you don't want to be in.
No, and you've got up on your screen a little promo for the podcast we do. Um, but we get into a lot about the legislation, the makeup of Congress, what's at stake in this election, which I think is worth listening to beyond just the market implications for certain sectors or certain stocks. Um, I mean, you drill, baby, drill, right? If we drill for more oil, then there's going to be more supply, and that will decrease the price, which last I checked is
Right.
probably not profitable for.
Hurts oil companies.
Right, right.
Yeah.
But so if you took a second to really think about policy, um, you know, that that would lead you to some maybe contrary conclusions to popular belief. But at any rate, there's a lot more at stake here with taxes, state law changes. Um, so give this a listen for sure. But bottom line, as far as our market outlook is concerned, this volatility, this stress, we talked about this over the last couple of quarters when we mentioned the election. This time of year, even we had a question come in talking about seasonality, right? September is historically the weakest month for market performance. Probably because every other year you have an election cycle coming through and people get worried about the uncertainty and change that might take place. So I don't know that that has anything to do with anything economic other than just simply uncertainty. And I'd be remiss if I didn't throw out the old adage, but bull markets do climb a wall of worry. We had a fantastic run in the market over the last year since last October. It's not even a year, 7 months, 9 months. So to have some volatility, some corrections along the way, it's a natural part of the process. And as always, I would just say, if you are worried, reach out to your advisor, have that conversation. Let's talk through these issues and see what makes sense and revisit your financial plan and understand if we are still invested appropriately. Are you sitting on more cash? Maybe there's some opportunities that we should be putting more money to work, whether it be in bonds or stocks, right?
Right. The election is very emotional, right? Who wins, Republican, Democrat, the personality behind, the Republican or Democrat in running for it. Very, very emotional. Could cause you to make emotional decisions in your portfolio, but it's important to root those decisions in logic, in what's actually happening in the market, because the market doesn't care what you think about the president. We showed this slide in the podcast with Mike, where if you invested $10,000 in 1961 and then followed that all the way to 2023, but you only went into the stock market when a Republican was in office. So you only buy into the stock market when a Republican's in office. When a Democrat gets in, you go to cash. If you're only in when a Republican is in office, you would have earned a little over $100,000 by the end of 2023. If you only invested when a Democrat was in office, you would have earned right around $500,000. If you stayed invested in stocks, irrespective of who was in office, you would have ended up with $5.1 million, right? So, we shouldn't be using the stock market to vote on what we think about the president. We should be using the stock market to vote on, what we think about the potential of, our economy, the potential of, the stocks, the ingenuity, the entrepreneurialism, in the economy.
Yeah.
Right. And then for those who don't know who Mike Townsend is, we coined him, or I'll take the blame. I coined him the Schwab's Wizard of Washington, which you could tell by his facial expression. That may have been the first time anyone has ever said that to him. But he is the boots on the ground. He's a managing director at Schwab, and he is the boots on the ground in Washington. He's the guy going to all the political meetings, taking out, different people to lunches, dinners, going to the cocktail parties. So, he is the guy that knows what's happening on Wall Street. For Schwab, relays that to investors, et cetera. But just a lot of great snippets there. We even talk about the Tax Cuts and Jobs Act, which, if you are an ultra high net worth individual, you should have your eye on, because there are definitely tax planning, estate planning type topics that you should be thinking of based on the Tax Cuts and Jobs Act. So we talk about it in the podcast with Mike. Also, if you go to our Amplified Wealth podcast, there is a TCJ, was it TCJA?
Yep.
Podcast that we did through Tom Farrell and who's the other, who's the co-host? Kate Fishbein, two CFPs, great people. They have a wealth planning version of Amplified Wealth where they go into a lot further detail with an estate tax professional who has been who has written for Forbes and things like that. So another great episode to watch, through that.
Awesome. Should we dive into some of the questions we got? I know we answered a bunch throughout, not necessarily shouting them out, but we did make sure to work in some of the questions there. I've got a good one for you, Austin. Where will the Dow Jones be at the end of the year? And this sort of has a follow-up, separate question, but how do you think the markets will do in the back half of the year, given that we've had a pretty good front half of the year?
Right. Well, so I guess my initial response is, where will the Dow Jones be? And I'm more concerned about the S&P 500. I think the Dow Jones, it served its purpose back in the day of being a very efficient way of gauging where the markets are and how they're trending, they're performing. But it is definitely an old school methodology. I think that the S&P 500 or even the Russell 1000, Russell 3000 are better indicators of, how the stock market is performing. They include more names, based on that market cap weighting methodology. I think it's just better overall. Where do I think it'll be? If I had to flip a coin, I'd say it would be up, but I'm flipping a coin. I think that, looking at the data coming into election, we tend to get more volatile, right? Because like Adam said, the market doesn't like uncertainty. But as after the election, the market tends to do pretty well because there's certainty added back to the market, because now the CFOs, the CEOs of these businesses know who's in office. They have an expectation of what policies will look like, what tax reform may look like, and they can make better decisions and put cash to work. So, that's my feeling on that. What do you think?
Well, looking at the data, when you have a double-digit first half of a calendar year, then more often than not, the returns are also positive in the back half of those years, right? And again, I think this comes to, what is the market telling you? The market is anticipating better than expected earnings or earnings growth in the months and quarters ahead, and that tends to follow through. So I think that's a pretty important trend to look at. I think it's also important to talk about the fact that markets don't really care about calendars, right? Whether there's a crash or some really good catalyst in the spring or the fall, the markets are going to react to that information. So, I think the reason we're seeing a little bit of a correction here, and we had a bunch of questions coming in around the markets of late, giving back some of these gains. I think a lot of it is just due to the uncertainty of what we have, both in Washington, with interest rates now, with the economy. You see geopolitical tensions in the Middle East starting to rise again. So there's a lot going on that is causing concern for investors. Typically, the last couple months, November and December of election years, are overwhelmingly good and positive for the markets just because that uncertainty goes away. So that is something that I think maybe is a tailwind to markets that people are not really looking forward to at this point.
Right, right. We did have a question come in about counterfeit shares and the impact on the market. I would say if you're really interested in discussing that, reach out. But that has to do a lot with short sales, which actually help make the market more efficient. The counterfeit share part of it is something that I think we need more legislature around. We need our government bodies to really get that under control. But when it comes to charting and looking at the markets, I think that's why it's important to pair fundamental analysis with any type of charting you may do. But good question. I don't want to dive too deep into it because it gets pretty complex. But good question.
And I guess the last one I'll mention, any insight on legislation or changes to early childhood education programs and funds? That would be a good one, Tom and Kate, if you're listening, to highlight on one of your next Planning Amplified Wealth podcasts. But also, I would say that is going to be determined by what happens in the election. I would say, what's in place or more funding might be available if there's gridlock or Democrats can squeak out victory in the House or surprisingly in the Senate. But if there's a Republican sweep, then maybe you see negative impacts there on spending programs and funds.
Right, right. Well, great. We really appreciate you guys joining us today. There will be a survey once you exit out. Please fill it out. We definitely take that information constructively, good and bad. There will be a recording of this on our YouTube channel if you want to share with anyone. Check out Amplified Wealth. All great stuff. Like, follow. We got to fool the social media companies into thinking about how popular we are. So please reach out and do all the interactions.
Thank you. Appreciate everyone's time and enjoy the rest of your summer.